If you've been watching markets closely and still missed this, you're not alone, but that's exactly the problem. While attention stayed locked on tech stocks, crypto cycles, and AI headlines, a much older asset began moving in a way that quietly punished anyone who wasn't paying attention. Silver didn't just rise, it repriced itself. Over the year, silver surged more than 160%, reaching levels many analysts once called unrealistic, even impossible. At one point, it pushed beyond $80 per ounce. And if that number sounds hard to believe, that hesitation you just felt is the same reaction most investors had right before they realized they were late. This wasn't a viral trade. There were no flashy headlines at first. That's why it worked. Gold moved alongside it, climbing more than 60% and breaking record highs. Central banks aggressively increased gold reserves, signaling something deeper than inflation hedging. When institutions that think in decades start shifting this fast, it's rarely about short-term fear, it's about long-term positioning. But silver's move was different, more uncomfortable, more revealing. In the US, silver is no longer treated as just a precious metal. It's increasingly viewed as a strategic industrial resource. It sits at the center of solar energy, electric vehicles, advanced electronics, and defense-linked technologies. Demand accelerated quietly while supply failed to keep pace. That imbalance didn't create a spike, it created a reset. Here's the part most people missed. While silver and gold were rewriting expectations, the rest of the commodities market was doing almost the opposite. Oil struggled under weak demand and heavy supply. Agricultural commodities like sugar and cocoa failed to keep momentum. This wasn't a rising tide lifting all boats, it was a split market. And that split matters. Because when markets stop moving together, it stops being about luck and starts being about awareness. Some investors recognized the shift early, others didn't, and many still don't. That gap is where regret usually forms. Ask yourself this honestly. Were you watching this unfold in real time, or are you only hearing about it now? And here's the uncomfortable question no one asks yet. If silver already made this move quietly, what else is setting up the same way right now? Now, we break down why energy and soft commodities stalled while metals broke free, and why this divergence may be the warning signal most portfolios are ignoring. If you think this move is over, that assumption could cost you. If you didn't notice the split when it started, the damage didn't show up immediately. That's how these cycles usually work. By the time most investors realized silver and gold were breaking away, the opportunity gap had already formed, and closing it became harder with every passing move. For years, commodities trained people to think in groups: energy, metals, agriculture, all rising and falling together. That mental shortcut worked until it didn't, and when it failed quietly. Energy markets ran into resistance almost invisibly. Oil prices softened as global demand slowed, but supply never truly stepped back. Producers kept pumping, inventories stayed high, price action flattened. For anyone expecting oil to lead or protect a portfolio, returns quietly underperformed. Soft commodities followed a similar path. Sugar, cocoa, and other agricultural markets adjusted faster than demand could grow. Production cycles normalized, weather risks faded, speculative money moved on. Nothing collapsed, but nothing accelerated either. That's when the divergence locked in. Because this kind of market split doesn't rewind cleanly. Once capital rotates this way, it rarely pauses to let everyone catch up. While attention drifted toward weakening energy charts, metals started operating under a different rule set. Gold attracted institutional positioning, not panic buying, but strategic allocation. Central banks weren't reacting to headlines, they were preparing for a longer period of financial fragmentation, rising debt, and reduced trust between systems. Gold became insurance. Silver did something more dangerous. Its demand kept rising while most investors stopped watching. Silver wasn't just benefiting from fear or speculation, it was being pulled into real-world systems: solar infrastructure, electric vehicles, advanced manufacturing, defense-linked supply chains. These projects don't wait for market sentiment to improve, they move forward regardless. And while demand quietly climbed, supply couldn't adjust fast enough. Mines don't scale overnight. Processing doesn't accelerate on command. That imbalance grew in the background while capital stayed distracted. This is where investors get trapped, not by volatility, but by familiarity. Oil looked normal, agriculture felt cyclical, silver felt boring until it wasn't. Ask yourself this honestly. Did you recognize this divergence while it was forming, or only after metals had already separated? Because once markets stop moving together, they stop forgiving late awareness. The longer the split holds, the more costly misalignment becomes. In the next, we expose who was repositioning during this split and who wasn't. And if you assume institutions move after trends become obvious, that belief alone may explain why this cycle feels harder to read than the last. Here's the part that makes most investors uncomfortable, because it forces an honest question. While markets were splitting and attention stayed fragmented, someone was moving, and it wasn't the crowd. By the time trends feel obvious on social media, positioning has usually already happened elsewhere. Institutions don't wait for confirmation the way retail investors do. They move when narratives are still unclear and conviction feels premature. That's exactly what made this cycle dangerous. As energy prices softened and commodity headlines lost urgency, institutional capital didn't retreat, it rotated. Quietly, methodically, not in response to breaking news, but in anticipation of what comes next when systems stop behaving normally. Central banks increasing gold reserves wasn't a reaction to a single event. It was a signal, a slow, deliberate shift toward assets that sit outside political pressure, currency risk, and financial trust. That move didn't start after prices surged, it started before most people noticed the change in tone. Silver positioning followed a similar pattern, but with an added layer of misdirection. Silver doesn't trigger fear the way gold does, it doesn't scream crisis. That's why it works. While retail attention stayed focused on growth stocks, rate cuts, and energy cycles, silver demand kept building inside real-world infrastructure. No headlines, no urgency, just steady absorption. This is where timing anxiety should kick in. Because the most dangerous phase of a cycle isn't the crash, it's the quiet repricing. That's when people feel safe. That's when assumptions harden. That's when being late doesn't feel costly yet. And once that phase ends, it rarely offers a rewind. Here's what most investors get wrong. They assume institutions chase performance. In reality, institutions chase conditions. They don't wait for prices to prove a thesis. They position before prices make it undeniable. That creates a psychological trap for everyone else. When prices finally break out, retail investors feel late but still hopeful. When they hesitate, believing a pullback will come, capital has already moved on. This is how missed cycles are rationalized, not through ignorance, but through delayed belief. Ask yourself something carefully. If this repositioning was already underway before silver separated from the pack, what stage do you think the broader market is in right now? Because once institutions finish building exposure, they don't announce it, they let price do the explaining. And by the time price feels convincing, the risk has already shifted to whoever just arrived. In the next, we'll confront the hardest question of this cycle, whether this move is already mature or whether most investors are still misreading where the real risk now sits. If you assume this phase looks like the last one, that assumption may be exactly what puts you on the wrong side of the next shift. Here's the question that separates awareness from assumption, and it's uncomfortable for a reason. Are you actually late to this cycle? Or does it only feel that way because the real risks haven't shown themselves yet? Most investors misjudge this moment because they're looking for familiar signals. They expect volatility, they expect panic, they expect headlines screaming urgency. But the most dangerous phase of a cycle rarely announces itself that way. Right now, markets feel oddly calm for how much has already shifted. Silver and gold have repriced, energy stalled, capital rotated, institutions adjusted, yet for many portfolios, nothing feels broken. That's exactly why this phase traps people. When damage is quiet, denial feels reasonable. This is where timing anxiety becomes costly. Investors who missed the early move often wait for a pullback that never fully arrives. They tell themselves the opportunity is gone, or worse, that it never really existed. Both beliefs lead to the same outcome: inaction during a transition. But here's the part most people still don't want to confront. Late cycles don't end when everyone feels late. They end when positioning becomes crowded and risk becomes obvious. And we're not there yet, not even close. The bigger risk right now isn't chasing what already moved, it's misunderstanding what this move represents. Silver wasn't a one-off anomaly, it was a signal that markets are rewarding assets tied to physical systems, long-term infrastructure, and institutional necessity, not just narratives. That shift doesn't reverse easily. When capital reprices based on structural demand rather than sentiment, volatility tends to arrive after positioning, not before. That's when people realize safety was an illusion and timing suddenly matters again. Ask yourself something carefully. Are you waiting for clarity before adjusting, or are you assuming clarity will arrive before risk does? Because in cycles like this, clarity usually shows up after the window narrows. This isn't about predicting prices, it's about recognizing phase changes. And phase changes don't feel dramatic in real time. They feel boring, uncomfortable, and easy to ignore, until they aren't. Most investors won't lose money because they made the wrong trade. They'll lose opportunity because they waited for certainty that never came and missed alignment instead. The uncomfortable truth is this: if you're only now starting to question your assumptions, you're not early, but you're also not too late. What matters next is whether you keep watching or go back to sleep while the cycle finishes reordering itself. The next phase won't ask for your attention, it will take it. And the difference between being early and being exposed will come down to whether you recognized this shift before the market forces you to.